We have this incredibly bloated financial sector. It's a phony crisis. They don't have to be cuts. We know how to get out of a Great Depression. You spend money. If we take a look at the typical worker, they're not doing fine.
Hi, I'm Dean Baker, your host for Mostly Economics, and today I have with us Eileen Appelbaum, who's one of the country's leading experts on private equity, and also my boss at the Center for Economic and Policy Research. She's the co-director. So welcome. Good to have you on Mostly Economics.
Thank you for having me, Dean. It's a pleasure to be here.
So let me start. You've been researching private equity. It's been close to 2 decades now. And when I say you're one of the leading experts, that's certainly true. You've been writing tons on it. You're deep in the weeds, but let's just start at the beginning. What do you see as the basics of the private equity model, and how does it differ from a normal corporation? And again, I know this is very obvious to you, but tell everyone here.
Thank you for that. That's a really good place to begin. So private equity firms they're investment companies, and they recruit institutional investors, mostly some wealthy individuals, but they recruit pension funds, insurance companies, sovereign wealth funds, endowments to join them in a private equity fund. So they recruit all of these people to put money into the fund, and the fund then goes out and buys companies. This is still the major part of private equity. It's 80% of their operations, although they've diversified some since then. But this is a really important part of their operations. So they recruit these investors, and the private equity firm itself puts in 1 to 2 cents for every dollar its investors put into the fund. And that's an important thing to keep in mind. So now they take the money, they go out and they buy companies. And they buy the company, in the cases that we're going to talk about, with a lot of debt. This is called a leveraged buyout when you buy the company with a lot of debt. And the way the debt works is also very interesting and really hard for people to get their heads around. So the private equity buys the company. It owns the company. It has put the debt on the company. But somehow it is the company that has to pay back the debt. It's as if you bought your neighbor's home. You own the home, but they are paying the mortgage. It's a sweet deal if you can get it. And if anything goes wrong, it's the reputation and the credit rating and so on of your neighbor that is going to be affected. And that's how it works when private equity buys a company. This is very different from publicly traded companies. They are responsible for any debt they put on their company. So they're much more conservative, shall we say. A typical publicly traded company will have a financial structure that's 40% debt, maybe 30%, but these days 40% debt, and 60 to 70% equity. It's reversed in these leveraged buyouts. The company that is owned by private equity will have 70% debt typically and 30% equity, and it can go as high as 80 or 90% debt. So now the company is burdened with all this debt that they didn't have before the buyout, and they are in a position where they have to make enough money, they have to have enough margin to service that debt. And that's a lot of where the layoffs come from. The easiest thing to cut quickly, because you got the debt from one day to the next. It's not like you piled it up over time. And the easiest way to cut quickly is to cut workers. So that's where you see a lot of the cuts in labor as private equity takes over companies. There are other things they do to increase the bottom line. One of the things that the debt does for them, by the way, is that it lowers the taxes of their companies that they own, that they've acquired. Because you're able, when those companies have to go to pay their corporate income tax, they are able to subtract 30% roughly It's a little bit different these days, but roughly speaking, 30% of the debt from their earnings, and so they have a lower tax rate, and that immediately, by the way, raises the value of the company. Their net revenue is higher, so the company is now more valuable. You've got fewer workers, your costs are down, the company is more valuable. None of this can be done by a for-profit company.
Just
Okay,
to clarify one of the points there, because this is actually an old issue that economists talked about forever, that there's this asymmetry between debt financing and equity financing. Obviously private equity takes that to an extreme, but if a company issues $1 billion in new shares and they finance it that way, the shares, they're not able to deduct, presumably most of the benefits to the shareholders are capital gains, particularly these days when they pay out less in dividends. That's not deductible. Whereas if they were to borrow $1 billion, then the interest they pay on the debt is deductible. So there's a long-standing asymmetry, and obviously private equity carries that to an extreme, looking to use 70 or more % of its financing as borrowing.
Yes, that's a big part of it. And of course, as we'll talk about later, debt is a two-edged sword. So it's really good for the private equity companies, but very dangerous to the financial security of the company that they acquired. But moving along, so now they have acquired this company, and their goal is to sell it in 2 or 3 years, or 3 to 7 years rather, and they have to do the best they can to make this a really attractive company that somebody will want to buy. So they do that, they sell it, and let's say they sell it at a profit. The interesting thing here, and I told you to remember that the private equity firm only put in 1 to 2 cents for every dollar its investors put in, but at the end, it collects 20% of the profit. Now, this 20% of the profit is actually a performance, being paid for performance. The way a bank president gets a bonus or a CEO of another corporation gets a bonus, those bonuses are for good performance, and they are treated as ordinary income and taxed for people in the highest income brackets at around 40%. And that's what they would have to pay. But capital gains, you are an investor, you have invested in this company, the company is sold, and you have a gain. Capital gains are taxed at 20%. So this is a huge advantage to all of the private equity people who are getting these gains when they sell the companies and are being taxed on that at half the rate they would have to pay if this income was treated the way a bonus for a corporate CEO is treated in the tax code. But
this is worth, again, if I could just break in for a second. This is the carried interest. People may have heard this term as carried interest. And this is something, again, when I first heard about this, probably about 20 years ago, a friend of mine told me, and I thought, oh, that can't be right. He's explaining it to me. I go, yeah, it can't be right. And then I looked it up. I saw it was right. And then I contacted a friend of mine, conservative, someone who actually was in the Bush administration. I said, well, what's the justification for this? And he said, well, these are very rich and powerful people. So I said, well, I know that, but I mean, what's the economic justification? And he said, there isn't one. He didn't even try. So
you are totally right.
That's what we got here.
And they lobby hard for this. They lobby hard in every administration. Trump wanted to get rid of the carried interest loophole. That lets them pay such low taxes on the gains from when the private equity fund sells some of the companies that it owns. So so that is what carried interest is about. The other things I want to say about how they are organized. So we've talked about the fact that they have these investors. They charge these investors 2% of whatever they have committed, whatever money the pension funds or the endowments have committed to the private equity fund. They pay 2% of that every year. So if you have $100 million investment in this fund, after 10 years at 2% a year, only 8 million of it is actually available for investment. 80 million is available for investment on your behalf. So that's a big part of how they make money. They take that right away, and it's the reason they want to get bigger and bigger. And it is actually the major and steadiest part of a private equity firm's income. So, I think that's an interesting point. The other place that they get money is that they, and this no publicly traded company could do this, they charge their private equity, the companies they've acquired, they charge them monitoring fees. You will pay us millions of dollars a year so that we can surveil you and make sure that you're doing everything in our interest. And you pay us for that. So that's another thing. No subsidiary of a big corporation pays a fee to the headquarters so that the headquarters can surveil them and make sure that everything they're doing is in the headquarters' interest. It doesn't work like that. And
the description of the relation. Sorry, the description of the relationship between the private equity company and the portfolio companies, you might not like this analogy, but I happened to be watching some nature show, I don't know, a month or so ago, and it was going through predator-prey relations, and it had the example, and it was very nicely filmed, of a wasp and a cockroach. And the wasp stings the cockroach, and basically it paralyzes the cockroach. The cockroach is still alive, but it's totally paralyzed. And then the wasp lays its eggs in the cockroach, and the eggs grow and they become full-fledged wasps. And, at some point, I guess in there, the cockroach does die. But, anyhow, it seems very similar to the relationship between private equity companies and portfolio companies. They do whatever they want with them.
That is so funny. That is true. So one of the differences between private equity and, let's say, hedge funds or venture capital is that private equity comes in and buys up the whole company. It replaces the CEO with somebody loyal to it. That's what happened at Toys R Us. The person that private equity put in had no knowledge either of retail or of toys. They just knew how to make money for the private equity company. Well, it didn't work, and as everybody knows who's listening to this, Toys R Us went bankrupt. You would think it could not go bankrupt. It was the biggest toy company in the world. But there you have it. But the last thing I wanted to talk about are what are called dividend recapitalizations. So you've already loaded all this debt on the company. And if it is possible, you will load more debt on the company in order to pay yourself, the firm and its investors, a dividend. That's called a dividend recapitalization. Go out, borrow money, and give it to us. And basically they do it because the private equity firm that owns them controls the board, controls the CEO, has replaced any top management that doesn't want to go along with the program, and they do have complete control, more or less like the wasp that after it paralyzed the cockroach. They do have complete control. So they have all of these ways of making money that are not available to publicly traded corporations. And the amazing thing to me, they will talk freely about all the companies they own, what they've done, how they manage them. They publish cases on how they improve the operations of some company. There's no question that they own them and they control them. But the courts treat them as passive investors. So you own stock in General Motors. General Motors goes out and does something bad. You're not responsible for that. And they treat the private equity firms just like that. Okay, you own stock in this company. The company did all these bad things, not you. So therefore, you are not responsible. Getting to the private equity firm is really, really hard. They call that piercing the corporate veil. Private equity firm is behind a veil, and we have to figure out how to pierce it. And I only know of 2 or 3 successful cases in all the years that I've been studying it since 2010 rather. So we're up to 15 years. And in all that time, I can only identify maybe 3 cases where the private equity firm was held responsible for anything. So
Weren't there, and maybe these are the cases you're thinking of, but weren't there some cases where the private equity company had to pay up workers' pensions?
that's not the that is no that's there was a situation where the Teamsters tried to do that, and that was a case where it pierced the veil. But
Yeah.
the judge who said, "Oh yes, private equity company is also responsible," sent it back to the lower court that had said private equity didn't do anything to decide what was going to happen. And so in the end, they didn't actually ever pay anything into the pension fund.
That's incredible. Was that the hostess case?
What?
Was that the hostess case?
No, Scott. I'm sorry, I don't have the exact name. It
Okay, no,
was,
no, I'm sorry. I
yeah,
just thought I'd
yeah,
remembered it.
yeah.
But then, yeah.
That was one of the cases. Hostess was not one. Uh, uh, the other one had to do with um, the bankruptcy of a big department store chain in California and in the West. And it was pierced on behalf of the vendors, and the vendors were paid. But,
Yeah.
but that's really one of the only examples. And there may be one more that I know about with Sun Capital. But in any case, it's rare. And so for the most part, private equity is just treated like you are treated if you own shares of stock in a publicly traded company and it does bad things. You are off the hook. And all the reputation damage goes to the company that went bankrupt or did the bad things or cheated workers out of their wages. All of the bad press, all of the bad reputation goes to the company and not the private equity firm. They escape even, the public outrage.
Yeah, this could really be seen, at least in my view, as a real failing of bankruptcy law. Because again, we understand the logic of bankruptcy law, but in this case, the controlling entity is not bankrupt. It's, they've
Right.
basically put the portfolio company by design in a position where it's very likely to be bankrupt because it's really no risk bet for them. So most
Right.
of what they have put up is borrowed. They pull money out, and as you're saying, they could often get dividends, so they could have everything paid back. And if the company ends up being profitable and they could take it public again, they've made a fortune.
That's
And
right.
if it turns out it goes bankrupt, they go, well, what do you know? Too bad.
That's right. They've already made their money from the shenanigans. Did I mention sale-leaseback? I think I did not mention that's another way that private equity makes money, the firm makes money that is not available to publicly traded companies. Anybody can do a sale-leaseback. That part is true. And publicly traded companies do them all the time. You want to invest in an expensive new technology. You don't have the money, but you own real estate. And so you do a sale-leaseback. You sell the real estate to a real estate investment company. You take the money and you buy the technology. And now you make more money going forward. You can pay the rent and everybody's happy. But when a sale-leaseback is done by a private equity firm, the private equity firm and its investors get the money from the sale, and it's the portfolio company, the company that they own, that has to pay the rent. So we have seen this has been behind a lot of the hospital bankruptcies. But you sell off the real estate, and then the hospital or the even retail companies, they like things that have lots of real estate. So hospitals, nursing homes, supermarket chains, retail chains, they sell off the real estate. The private equity firm keeps the money, and the organization, the operating company, has to pay the rent. And this is incredible. So that's another way they make money. So they make money. They make money by the sale-leaseback. They make money by the dividend recapitalizations. They make money by charging monitoring fees to the companies that they own. They charge management fees to their investors. They are making money everywhere, hand over fist. So it really doesn't matter to them. I've always said the successful sale of the company at the end is the cherry on the sundae. That's what it's worth to them, and they really don't care if they're successful in the end or not. I will have to say that most private equity-owned companies don't go bankrupt, and let me just talk about that a little bit. So
Okay.
we are talking here about leverage buyouts. There are 4,100 private equity funds. There are firms. There are 18,000 private equity funds. They own thousands and thousands of companies that employ millions of workers, 13.3 million workers. Most of these are small private equity firms, little private equity firms. They have a smallish private equity fund. They can maybe buy 10 little companies. You can't leverage a little company with 70 or 80% debt. Nobody is going to lend it to you because they don't have any assets in case the debt goes bad that you could claim. So those companies are leveraged in exactly the same way as publicly traded corporations. They are no more likely to go bankrupt than publicly traded corporations. Well, that is thousands of these investments each year, the acquisitions of companies each year. There's a handful of companies. Of the 4,100, there are probably 300 big enough to buy a company with enough assets to leverage them. And typically, the top 30 are the ones that we hear about, that we care about, and that do all the damage. So that's where the leverage buyouts are. Among the leverage buyouts, about 20% will go bankrupt before they're exited, before they're sold to somebody. They're resold. So it's a 20% bankruptcy rate compared to a little under 2% for publicly traded corporations. So the bankruptcy rate for leverage buyouts is about 10 times the bankruptcy rate in ordinary company, publicly traded companies.
Yeah.
All those companies that are bought with just 40% debt or less, they have no greater probability of going bankrupt than any other company. So if your denominator is all companies that private equity ever bought in a particular period, then they have the same bankruptcy rate. They have the 2% bankruptcy rate. But if you and these few really large ones raise it a little bit. So publicly traded is under 2%. Private equity, if you count everything, is a little bit over 2%. But that's not the issue. The ones that are bought by little private equity firms don't have any greater probability of bankruptcy than any other company. It's the leveraged buyouts. And while the number of deals is huge for the smaller private equity firms when you add them all together, the real money in private equity goes into the leveraged buyouts. The number of employees that are going to be hurt goes into the leveraged buyouts. They buy a company like Toys R Us, which at the time of the bankruptcy had 30,000 employees. Some of the private equity, the small ones that we highlight in our book, buy companies that have 20 employees, 30 employees. When they buy a restaurant chain, I've gone into restaurants now just to find out how many employees work here after all. You look at a shift and you say maybe, I don't know, a big restaurant, you might see 20 people. And then I just ask, a waitress, or usually a bartender has more information. You say, so, how many people work here altogether? Well, you're talking about in a big restaurant, a big one with a bar and open late at night and 20, whatever. You get the idea. You could have 60 people working there compared to 30,000 at Toys R Us. So, it does accumulate. But the point is that when you have smallish private equity firms having smallish funds, buying smallish companies, they can't load them up with debt. So by number of deals, they're doing fine. But by amount of money invested or by amount of employees affected, the leverage buyouts is where all the action is. So
I want to step back for a second, talk about the selling off of the real estate, because when you first told me about this, I was going, wow, this is kind of incredible. It's really striking because again, you told me, I'm relying on reading your work and talking to you, that it's standard for them to sell the real estate. So I believe they did this with Toys R Us. They do it with hospitals, as you're doing in your current work, studying your current work, and then those companies, the portfolio companies, are stuck with paying the rent. Now, what's striking about selling off the real estate and turning it into a rental relationship, that doesn't count as debt. So if you have a company, Toys R Us, and I don't know exactly what they sold the real estate for, but let's say they sold it for $1 billion. That's in effect $1 billion in debt, but it doesn't appear as debt because they now have a rental relationship. So they've given up an asset that would show on the books, but it wouldn't show up that they in effect have another $1 billion worth of debt, which they do.
That is true, but you will be happy to know that the tax authorities in the last couple of years make them now list their rent liabilities along with their interest. So
that's good. That's
it
certainly a
is
step
really
forward.
good. Yeah, it is yes. In private equity, you have to count that as a big step forward.
Changing the bankruptcy laws would be the bigger step forward, but yeah.
Yes, and in addition to the one that you pointed out, there are these fast track bankruptcies. They were established so that if you are a company going bankrupt and you have assets that will deteriorate very quickly unless they're sold to some other company that will maintain them, they allow you to do a fast track bankruptcy. Well, you can imagine that private equity has gotten its hands on these fast track bankruptcies, because in a fast track bankruptcy, there's no bankruptcy judge making judgments. This is happening too quickly. So if you have a unionized workforce and they have pensions, there's no judge to say, hey, you have to take care of those pension liabilities. There's no possibility for the union to say, this company doesn't have to go bankrupt. We see a path for it to move forward. All of the things that go on in a bankruptcy court do not go on in the fast track bankruptcy. So there was a dairy in Wisconsin. I guess you could say it needed a fast track bankruptcy. I don't see it that way. But anyway, it bought milk from the local, this is in Wisconsin, so it's buying milk from the local dairies, and it hires Teamsters, members of the Teamsters, to go out and collect all the milk and deliver it to wherever that has to go. Collect the milk from the farms, deliver it to the retailers. This was a Playboy owner of a private equity firm. But anyway, so the Playboy decided, too much trouble, I don't want to be doing this. Well, they had supplied the school lunches, the milk in the school lunches for all that part of Wisconsin. And they managed to get a fast track bankruptcy on the grounds that the milk would spoil. But really, you could move the milk out of there. That's not an asset that's going to deteriorate. And in fact, to the extent possible, they did move the milk out of there and get it to the school kids, move the other products. But it went under. It was allowed to do a fast track bankruptcy. The Teamsters had no say in the settlement. The workers had no place to raise their concerns. And that's what a fast track. I've already been at conferences where we're talking about bankruptcy and private equity. And I tell this story, I tell what is happening. It's very common now to get a fast track bankruptcy. If you have any basis at all to say, hey, we deserve one, that's a loophole that needs to be closed as well.
Just so people know, not that I'm an expert in bankruptcy law, it's very common for companies to operate, sometimes for very long periods of time, in bankruptcy. So the court could appoint a receiver and just say, okay, you have these assets that we're worried about. We don't want the milk to spoil. We have a receiver. They're going to run the company on behalf of your debtors, your creditors.
That's exactly right.
Again, that could go on for years sometimes. You don't want that, but there are occasions where that happens. So the idea that the alternative is the milk spoils or you do your fast track bankruptcy, that's just not true.
I know, but that's how it seems to be going. So yes, so that is how they make their money. That is why I used to say the house always wins. They always win no matter what happens. If they could sell the companies at a profit, I often wonder who buys these companies.
I gather you've looked at follow-ups. What happens to the public? When they go public again, what happens to them in subsequent years?
Well, I didn't really follow that up. Maybe that's a thing I should do. But I'm sure the ones that are highly indebted. Well, here's another trick. So you can't sell it to the public. Envision could not sell. KKR could not sell Envision, which had two parts to it: a physician staffing firm and walk-in surgery centers. Ambulatory surgery centers. it was so riddled with debt and also riddled with rent, and rents that were above market, and that had 20-year leases. Nobody would buy it. So they did a shenanigan, which I've seen now more than once, in which they give a note to the top doctors that the doctors can then use. They loan them the money so they can buy out the private equity company. And this has two benefits for the private equity company. If it goes bankrupt, they're not any worried, oh, we sold it a long time ago. But they're not responsible for it. But they are the largest creditor. So they get to dictate how the bankruptcy will go. The creditors usually dictate how the bankruptcy will go. And the largest creditor has the most power. So in a bankruptcy, they're the largest creditor. And if, despite this note and everything else that they're paying off, the healthcare system survives, they, in this note, wrote themselves a 30%, they would then retain a 30% stake in this successful company. How did they do this? How is this even possible? But this is the story of what happened with KKR and Envision.
I'll let you get more into healthcare, and I should just mention that you and your colleague Rose Bott have a book. I don't know if you have the publication date set yet, but in any case, a book coming out on private equity in healthcare in the not distant future. But I just want to say a little bit more about the relationship with their limited partners, the investors, because my understanding, I've looked at more from the pension side, but you've looked at it from the private equity side, that the limited partners tend not to do very well.
Okay, so here's a couple of things about I just wanted to correct one thing I said before. It wasn't Envision, it was the Steward Health System, where they Cerberus had that crazy note, sold it to the doctors. Okay, so what was the question again?
Oh, I was asking about the limited partners and the investment returns for the limited partners.
Okay, so there's so many things to say about them. First thing to say is they have no power. When the kids at Sandy Hook were murdered by a rifle produced by Remington, owned by a private equity fund that the California teachers were invested in, they tried to get out of it. They tried to have the fund sell it on the grounds that California does not allow those kinds of guns in California. Therefore, a California pension fund should not have to be invested. It didn't work. It just didn't work. They were stuck with it for as long as the private equity firm wanted them to be stuck with it. So they have no decision-making power, no power whatsoever. The second thing is that they have no idea whether they're making money or losing money. The SEC tried to straighten this out. And at the very end, why they can't do things at the beginning of an administration, I don't know. But at the very end of the Biden administration, the SEC passed a watered-down rule, so watered down that I had to complain about it. But anyway, a watered down rule that required minimally for the private equity firm to state clearly to the private equity fund how much it had paid into the fund and how much it had received back from the fund. It seems mind-blowing that they cannot tell. So one of the reasons that they cannot tell is the private equity fund has all of these companies that it owns. Well, what are the companies worth? The private equity fund gets to tell you what the companies are worth. In all other situations, the pension fund would have to have enough information to be able to include that information in its balance sheets. It would have to know enough about what was happening to be able to value those. It would have to know enough about those companies in the portfolio to be able to value them itself. There's an exception for private equity. It's the only financial organization for which this exception exists. The private equity firm is allowed to estimate the value of the companies in its portfolio. So these are guesstimates, can I just say? They might be slightly anchored in reality, sometimes not even that, but everybody loves it. You're a pension fund, and they're always telling me private equity is my best performing asset. Yes, because all of the things that have not been sold yet have fictitious values, very high fictitious values, set by the private equity firm. It's not money you could take to the bank. And they've gotten in trouble with it now. If we ever we have time to talk about the current situation. But in any case, they don't really know how much they've paid in, how much they've gotten back. And this, of course, this rule was immediately dismissed by the Trump administration. So they still don't know what they're paying. But they believe, and they like to believe, that all that money that the private equity firm tells them is there is really there, because it makes the pension fund look good. It also makes, so there'll be some manager in a pension fund who's responsible for private equity investments. That manager loves it. Their bonus is tied to how well did the private equity fund perform. So the fund is performing fabulously. Just ask the private equity firm. And the firm doesn't want to reveal it. The fund doesn't want to reveal it. The pension fund doesn't want to reveal it. And the pension fund manager doesn't want to reveal it.
Yeah, just to back up a little bit from the standpoint of the pension funds, because obviously pension funds, here I'm thinking primarily public pension funds, they've been under a lot of pressure the last, 20 years or so, and some of them are badly underfunded. Most of them are reasonably well funded, but like Illinois is one I'm familiar with, probably because my mother's in the Illinois pension fund. But in any case, you have a number that are seriously underfunded, that serious funding issues, and private equity turns out to be great for them in the sense that they can write down big returns. They might not see those returns,
right,
but in 225, they could write down, oh, we're doing great. Look at this. And
right.
For that reason, they love private equity. But again, if you could say, no, what are your actual returns? They don't get to just write down,
That's right.
whatever they feel like.
That's right.
It almost certainly wouldn't look that good. And where you have closed funds, so you've had your money in there for, was it typically 10 or 12 years, and then it's closed, their returns generally aren't good. I haven't seen the latest data on that, by my understanding.
Yes, so I could talk about that a little bit.
Okay.
So private equity actually did very well between 1996 and 2006. And here's what I mean by that. We take all the funds that are launched in a particular year, say 1997. The median fund launched in that year will earn, over that 10-year period, it will earn, its total earnings will beat the stock market by about 3%. And that is considered payment for the extra risk of investing in private equity. You should get more money because you're taking on more risk and less liquidity. The median fund was that high. That means the quartile below the median was also doing, not losing money anyway. Only the bottom quartile lost money in those years. And the top quartile, if the median is beating the market by 3%, the top quartile is doing even better than that. So we had that 10-year period in which the median fund launched in each year beat the market. Private equity is living off that reputation. From 1996 on, they have not beat the market. The median fund has not beaten the market in any year. They match the market. The median fund will match the market. You're not doing worse than being in the stock market. But that means that half the funds are doing worse than the stock market. There are half the funds in which you would have done better if you had been invested in the stock market. And if the median fund is just matching the market, the next quartile up is, beating it by a little bit, but not by very much. It's only since 2006 or 2007, it's only the top quartile funds that have made any money. Now, back in that period from 1996 to 2006, if you had a particular fund manager, somebody in the private equity firm responsible for managing the fund, and that fund did well, and that manager is managing a subsequent fund, that subsequent fund had a high probability of also doing well. They call this persistence. That has not been true since 2006 either. It's a crapshoot. Who's going to be top quartile? Sometimes it's the company, the fund the previous fund was bottom quartile, and now the next fund is top quartile. There's like no advantage to having been top quartile in the past. There's no magic thing going on here. So since 2007, they've just about matched the market at the median. They've lost money below it. They've barely made any money just above it. And the top quartile does well, but the top quartile changes with every year.
Yeah, this would be very similar if a pension fund were just going to say, we're going to take $1 billion and put it in one stock. And if they pick the right stock, of course, they do very well. But if they pick the wrong stock, well, they've thrown a lot of money in the garbage.
That's exactly right. That's exactly right. And in the most recent period, looking at the pension funds and the endowments, which of course have not only private equity in them, but the private equity is supposed to be boosting their earnings. And their earnings in 2024 were below what you could have gotten with a Vanguard index fund that was, let's say 60% equity and 40% bonds. You would have, that's called a plain vanilla portfolio. You would have done better with plain vanilla than investing in private equity. I mean, the pension funds would have. So
we've been going on for a while. I wanted to give you a chance to talk about healthcare because obviously you and Rose have been doing a lot of work on this, and it's a huge and growing area for private equity, and obviously a huge and growing area for all of us. So if I could ask you about, what do you see as, where are the big areas where private equity has been getting into healthcare?
Yes. So of course, we talked about it a little bit before. The nursing homes, the hospitals that own a lot of real estate, private equity buys them up, sells off the real estate. And here's the other part of that sale-leaseback agreement. If you offer in the lease to pay above market rents with an automatic accelerator for 20 years, you get a much higher price on the sale. So it's not just a sale-leaseback, it's a sale-leaseback with a lease for 20 years with above market rents that will rise every single year. This is a big part of what destroys the healthcare system. And the other thing, of course, is that we have laws against the corporate practice of medicine. But when a private equity company owns a hospital, okay, it does not tell the doctors what they're supposed to do, but it measures them. It measures them on metrics that are not appropriate for a healthcare system or for a hospital or for a doctor. They measure them on, how many patients they see, how many admissions they have, how many admissions they get rid of quickly after they charge you all the money, shorten the duration, order unnecessary tests, but then don't do any care. It's like get rid of the nurses, substitute nurse practitioners for doctors. And of course, there's a major role for nurse practitioners. I'm not saying that, but there are some things that need to be done by doctors or in tandem. And they just cut back the doctors, they cut the cost, they cut the staffing. People die. People actually die. And they may not be telling the doctors what to do, but they are constraining them in such a way that they can't really practice medicine. And this has become such a widespread phenomenon that it has a name. It's called moral injury. The doctor wants to do what's right for the patient. Their employer wants them to get through this thing as quick as possible, make as much money for them as possible. And this is a tremendous tension because you have to understand, if the private equity company owns the hospital and the hospital either owns the doctor's practices or is staffing from one of the private equity owned staffing companies, but in either case, the doctor is not part of a practice. The doctor is an at-will employee. They can be fired if they're not meeting whatever criteria, either the private equity firm that owns the doctor's practices or the hospital, which has doctors. They don't have doctors that are employees of the hospital. They have an off-site hospital owner, a physician, a staffing company, a hospital-owned physician staffing company, and it's no different than private equity. In fact, the doctors that I've talked to said it's worse than private equity because the hospital actually thinks it knows how you should be treating the patients. Not only are they rushing you through whatever it is you're doing and making sure that you're maximizing income for them, but they're also commenting on how you're treating the patient because they think they know about it. So this is a really terrible situation, and patients don't get the care they need. They don't get the necessary tests, but they get a lot of unnecessary tests. It's just having for-profit ownership of hospitals is really bad, and private equity is worse, as we've been talking all along. When a publicly traded corporation, for-profit, owns the hospital, yes, it aims to make a profit, but it aims to stay in business for the foreseeable future. Whereas the private equity firm wants to make a lot of money quickly and then go. HCA is our biggest publicly traded for-profit hospital system. They've never sold off any of their land. They have never done that. And they're there for the long term. They want to stay in business. So they do try to make a profit. They are aggressive, but they don't operate the way private equity firms operate.
Yeah, that's an incredibly important point, because obviously there are problems with for-profit medical care more generally, and we might want to change that. But in any case, where you actually have a hospital that expects to be there for the indefinite future, they actually, regardless, it's not whether they're soft-hearted or anything, but if they have all these patients that end up dying because they came in there with a bruise or whatever, something you shouldn't die from, that's really bad for them. Patients will stop going there. They're going to get called on the carpet. On the other hand, if you have a hospital being run a private equity company that's perfectly happy to see it go bankrupt because, they've gotten their money out of it, they don't care. And that's a really big problem. I remember you had done something, and I forget whether it ended up being a paper, but you had sent me something you're working on, looking at hospice care. And so maybe you could, you know more about it than I do, so you could.
So here's another crazy thing about our healthcare system. And I want to tell you that it was the Democrats as much as the Republicans that made this happen. So hospice became a Medicare benefit around 1983. Before that, these were little volunteer organizations connected to a hospital that tried to help people who were in the last stages, about to die, get through that experience with the least amount of distress and so on, and pain especially. So that's what hospice was. And now Medicare is going to pay for it. And the problem, the big problem, is the payment model. The payment model is what I call a capitated payment. What this means is they give the hospice money. For every patient that is enrolled with that hospice, they get a fixed amount of money every day paid to them in advance in order that they should be better able to care for the patient. And the idea behind it, noble as it was, is that if you give them the money in advance, they will be able to make sure that they can provide this patient with the services they need. So, for example, dementia patients at the best hospices go to these adult centers, the adult daycare centers, where they get mental stimulation, they hear music, a lot of things that go on that they don't just sit and rot. But then the hospice has to pay for that. You have the money up front. You can pay for it, or pay for a social worker to visit the patient. Most hospice is done in the home, to visit the patient in the home, to make sure that things are okay in the home. Okay, so that's the theory behind it. And in fact, with the nonprofit hospices, that is what happens, by and large, not always, but by and large. But in the for-profit hospices, and the point of it is you have all of this stuff, the patient is healthier, and they're less expensive to care for. And that's how you make your profit, because you get to keep all the money. In a capitated system, you get to keep all the money you did not spend on the patients. Okay. Private equity noticed that, well, actually, the tiny little, what some people call cockroach capitalism, the tiny little evil capitalists, little ones, when it's very easy to get into the hospice business. In some state, Maryland controls it, but California is the worst. It's really easy to hang out a shingle and say we're a hospice. And so they got into it, and they, of course, did not take care of the patients, and then there would be lots of complaints. They would go under, they would reopen with another name. Private equity observed this. They noticed this. And so they said, we could do really good here. And so they came in and they bought up the hospices. Today, 75% of hospices are for profit. It used to be a very small fraction. Before 83, there was no private equity in hospice, and it took them a few years to figure this out. But now 3/4 of the hospices are owned by private equity. And the only thing you are legally required to do in order to get paid by Medicaid is to have a nurse visit the patient once every 2 weeks. In between, you don't have to do anything.
Good.
It's incredible. And if it's a cancer patient, they need way more visits because they are in pain and they need pain management. If it's a dementia patient, you could probably get away with it. And of course, families have no idea what to expect. So they have no idea whether this is good care, bad care. What do they know? So private equity has made a fortune in hospice. It has bought up the nonprofit hospices and it has treated them maybe a little bit better than the cockroach capitalists. They don't want families complaining about paying, things like that. But they do very little. And we can see this because over the last, 7 or 8 years where I have data, we see that for the operating margin based on their Medicare payments is a triple the operating margin in the nonprofits. So the operating margin in the nonprofits vary from, in some years, as low as 3%, more recently as high as 6%. And the for-profits have an operating margin of 18 or 19%. This tells you something about, who's spending money on the patients. But people do not know what to expect from hospice. They don't understand.
It's a classic case where, you don't have the normal, if we want to think of it like a classic consumer relationship, when I go and buy a computer, I can read up what the computer is and have a pretty good idea of what I'm getting. And, maybe I'm not happy with the computer I buy, but one thing, it's not at the end of the day a disaster. And two, I did make a relatively informed decision, or at least I could have. Whereas with something like hospice care, that's not something that people get repeatedly. It's,
Right.
you have a real problem with asymmetric information, and you could hope that the government regulates it, which sometimes they do a little bit. A lot of times they don't.
They do. And they are We're not the only organization, CEPR, making noise about this, but we are among the organizations making noise about this for a couple of years now. And again, at the end of the Biden administration, we got a lot of really good things. So we got a thing where the bottom 10% of the hospices, based on whatever rating systems they are using, they do have some rating systems, would be inspected more often. That's gone. We also got a lot more reporting by patients or their caretakers. Of course, the patient dies, so it's really the caretaker who fills out the forms. And there, it's the fact that they have no idea what to expect. They do not know what should be available to them. Some of the hospices, if you need expensive medicines to control your pain, they charge it to your Part D, Medicare or Medicaid plan, and don't pay for it. They're supposed to be paying for it. So the taxpayer is paying for it twice. They claim that they did that, or they kept the money you gave them to do that, but they also put the charge onto some other part of the program that taxpayers are paying for. So, and people are paying through their premiums. So this is, it's just absurd. We need way more regulation. This is the whole reason private equity gets away with what it gets away with. And that is regulation is really lax. The rules are loose enough that they're limited enough, and they are not enforced.
Yeah.
So there's the hospice.
We've covered a lot of ground. I don't want to keep you all day here, although I probably could go on a lot longer because obviously it's a big topic and you know an awful lot about it. Before I let you go, let me just ask you, is there anything that you were dying to say that we didn't get to?
Yeah, if I had enough time, yes, there is something. So in 2022, the private equity companies shot themselves in the foot. The stock market, the S&P 500 fell almost 20%. But since they don't mark to market, then they only have to tell you quarterly how the companies are doing. They did just fine. Maybe they went down by 4%, but they recovered really quickly. The companies in their portfolios are doing really fine. Well, everybody knows that those companies are overvalued. Private equity companies have shot themselves in the foot and are struggling now to recover. So in 2022, the stock market falls tremendously, and the private equity firms do not have to mark to market. So meaning they don't have to reflect the fall in the price of publicly traded companies in their evaluation of their own companies. So their own companies are just doing fine and are as highly valued in 2022 as they were in 2021, which was a peak year for private equity. Okay, all looks good in the short run. But now we've gotten past that. The other thing that happened between 2022 and 2023 is that the Fed raised the interest rate. It raised it really high, and they're holding the interest rates higher for longer than anybody expected. So these companies now, they can't sell the companies in their portfolio. They can't take them public because as soon as people entered that IPO and bought up the shares, you would see that the shares were valued far under what the private equity firm said they were valued at. So if one company is sold that way, the market is going to mark every single company in the portfolio down by however much that company failed in the IPO. So they can't sell it to the market. They can't sell it to strategic buyers because everybody knows they're overvalued. And even other private equity funds don't want to buy it from them at those high prices. So they're stuck with them. So you're stuck with them. You have the high interest rates. You have $3 trillion of companies in your private equity funds throughout all the private equity funds. They're holding it for longer than they expected. They have to refinance the debt that they put on it at 5% instead of 1%. They have a lot of problems, but they're hanging in there. They won't reduce the price of their companies. And so what has happened is they can't sell them. They can't get any liquidity. They can't return the liquidity to the investors. Investors use the liquidity that they got partly for their own purposes in a pension fund. They would use them to pay out current pensions without having to sell any assets that they didn't want to sell. But some of it they would take and reinvest in the next private equity fund. But they have no money to reinvest, or they're not willing anyway to reinvest. They're not getting money back. So except for the very largest private equity firms, about 6 or 7 of them are doing fine. All the fundraising goes to them. The rest of the private equity funds, including the rest of the 300 largest, not to mention the 4,100 others, they cannot do this, and so they are just sitting on these companies, doing their best to stay alive, refinance some of them. They're already going bankrupt. That's already happening, okay, so they can't sell them. They can't return liquidity to the investors. The investors don't want to reinvest, with a few exceptions that I mentioned. They can't exit. They can't fundraise. They can't invest. They can't do anything. And so they are desperate for a new place to fundraise. And so they are out there looking to capture a part of your 401k, just a little part. There's $8.9 trillion in IRAs and 401ks. A little bit of that. They'll be happy with a little bit of that. So they've developed these ETFs, exchange traded funds. You might be familiar with them. But anyway, it's basically an index fund. 85% publicly traded companies and bonds, 15% private equity. If the private equity goes under, you'll never know the difference. You won't lose your retirement. It'll just be lower than it would have been otherwise.
I just sent Eileen a piece from Business Week this morning about how Vanguard is looking to set up a fund that will include private equity in it. And I mentioned that. I mean, to me, it jumped out at me because Vanguard made its reputation. They invented index funds. The founder of Vanguard, John Bogle's kind of a hero of mine because he set it up. I think it goes back to the late 70s. Vanguard set up as a cooperative, by the way. It's not a private company. And Bogle, I'm sure, did fine. I'm sure he, made millions of dollars, but he could have made, I'm sure, 10 or 100 times as much if he set it up as a profit-making entity with himself as, obviously a leading shareholder. But the whole point was keep it simple, keep costs down. And they did that ever since they were created to the present. And it was just very discouraging to see that they were getting into private equity, which is obviously both complicated, untransparent, and costly.
That's right. Non-transparent, not especially liquid. They're hoping the ETFs will get them around the liquidity problem. It will work if, in fact, we have a situation where people need money out of they have to cash in the ETF because they need money for health conditions or some emergency has come up in their family. KKR has volunteered, just like AIG did in the mortgage crisis. KKR is going to ensure that it will be the last resort, and it will pay whatever people need who want to get out of an ETF that has private equity in it. Yes, that works if it's just a few companies that do that, a few people that do that. But if we hit a recession and it goes on for a while, and people need to dip into their retirement accounts in order to not lose their house or pay for their food, there's no, I hate to tell you, but there's no private equity company big enough to pay off all of those people. It's going to be AIG all over again. People thought that they were insured by AIG and didn't have to worry about the mortgages, but it turned out that didn't work. So it's a very dangerous situation. And what's going on is the massive, massive propaganda campaign. Pension funds are doing fabulously because they are able to invest in private equity. Why shouldn't you, ordinary Joe, be able to do the same thing as the pension funds and invest in private equity and make all that money? And because they're living off that reputation from 1996 to 2006, they're still living off of that. That's the propaganda. We make more money. The pension funds do better. You need to have the same opportunity. Now, here's the catch. Actually, in the first Trump administration, they got the leeway to be able to get into your private, with some constraints, the leeway to get into your private equity, into your IRA or your 401k. Well, employers balked at that because the fees are high, the performance might be bad, and you would be able to sue your employer. They were the fiduciary, and they didn't look out for you. And there were successful cases where employers were sued. Employers said, we don't want to be in this business. We don't care how pretty you make it. They're trying to overcome that. There was hardly any take up. Only 2.4% of all private equity, pension funds have a private equity option. The other 97 point whatever it is said, we don't want that, but we're afraid of being sued. So now they are trying to be able to assure the employers that it's all going to be okay. We'll see how that goes. But you are right that unlike Vanguard, the private equity in your 401k charges high fees, and as we've just seen, the reason they want your 401k is because they're not doing too good elsewhere. They can't get other people to invest. They can't get rich people or pension funds to invest the way they had in the past.
Okay, it's probably a good place to end it here. So
look out for that. Don't be snookered.
Thanks a lot for joining me on this. And
this was much fun.
We'll have to do another segment sometime.
I really enjoyed this. Take care.
If you like what you just saw, please help us out by liking us and subscribing. Thank you.